Imagine you're at a casino. Everyone is crowded around the slot machines, drunk on the noise, the flashing lights, the cheap dopamine of meme coins and AI tokens. But in the corner, quiet, almost invisible, sits a single poker table. And at that table, the world's most powerful banks are making the biggest bets in financial history. Nobody in the crowd even notices. That is the XRP story in 2026. And if you're still standing at the slot machines, this video might be the most important thing you watch all year. Here's something that doesn't make sense on the surface. A network that is currently processing over $3 billion in daily transaction volume, a token that Goldman Sachs has quietly allocated over $150 million into. A ledger that just recorded 875% growth in real-world asset tokenization in a single month. And yet the price sits there, still, almost boring. How does that happen? How does one of the most institutionally adopted assets in the entire crypto space trade like it's forgotten? The answer to that question is not a red flag. It is the entire opportunity, because markets don't reward the obvious. They reward the patient, and right now patience is sitting on something that looks, to the untrained eye, like a sleeping giant, but to anyone who's been watching the fundamentals, it looks like a volcano about to wake up. Let's talk about what's actually happening beneath the surface. Most people approach XRP from the top down. They start with price targets. They start with predictions. They start with hype. I want to flip that completely. Let's start from the ground floor, from the infrastructure, because that's where the real story lives. Think about the early days of the internet. In 1994, most people thought the internet was a toy for academics and tech nerds. Meanwhile, a small group of builders were quietly laying fiber optic cables under oceans, establishing protocols, and creating the invisible architecture that would eventually move trillions of dollars and reshape civilization. Nobody celebrated those engineers. Nobody made viral YouTube videos about TCP or IP. But 20 years later, those decisions became the foundation of Amazon, Google, and the entire digital economy. XRP is in that same position today, not as a speculative asset riding narrative waves, but as infrastructure. The XRP Ledger isn't being pitched as the future anymore. It's being used as the present, and that distinction is everything. When RCAX Exchange in the UK announces plans to migrate another $1 billion in tokenized assets to the ledger by year's end, that's not a press release. That's a construction contract. The building is being built, brick by brick, settlement by settlement, institution by institution. Here's a psychological pattern that repeats itself in every major market cycle, and almost nobody talks about it honestly. The loudest moments in any market are almost never the most profitable ones. Think back to late 2021. Crypto was everywhere. Your barber was talking about Dogecoin. Your aunt had a Coinbase account. ETFs were on the front page of the New York Times. That noise, that deafening, overwhelming noise, was actually the signal to be cautious. Now flip it. What does the market look like when the real accumulation is happening? It looks boring. It looks flat. It looks like nothing is going on. Daily active retail users on the XRP Ledger are near a yearly low. Social media sentiment is muted. Forums are quiet. The YouTube comment sections are half the size they were 18 months ago. And yet the on-chain data tells a completely different story. Institutional bots are accumulating, not in dramatic, headline-grabbing chunks. They're doing it quietly, mechanically, using time-weighted average price strategies so they don't disturb the surface. You won't see it in the price. But you can see it in the volume profiles if you know where to look. This is what accumulation actually looks like from the inside. It doesn't look exciting. It looks like nothing, and that's silence. That's not a warning sign. That's an invitation. To understand why this moment is different from every previous XRP rally, you have to appreciate what 2025 actually unlocked. For years, the single biggest anchor dragging on XRP wasn't the technology. It wasn't the competition. It was a question mark, a regulatory sword hanging over the entire project. The SEC lawsuit created a cloud of legal ambiguity that kept an entire category of institutional capital frozen on the sidelines. Compliance officers at major financial firms couldn't touch XRP. The risk department would not allow it. The court's ruling that secondary market sales of XRP do not constitute securities transactions wasn't just a legal win. It was a permission slip for trillions of dollars in institutional capital. Consider the analogy of a dam. For years, the legal uncertainty was the dam wall holding back a massive body of water that had been building and building behind it. The 2025 ruling didn't open a valve. It cracked the dam, and now the water is flowing, slowly at first. But the crack is getting wider every single day. The evidence of this is hiding in plain sight. Ripple's board now includes veterans from JP Morgan's Regulatory Affairs Division. Those aren't people who join startups. Those are people who join institutions they believe will become systemically important. You don't put your name on a company's governance structure if you think it might be a footnote in financial history. You do it because you believe it will be the history. Let's talk about something that doesn't get nearly enough attention: the structural mechanics of how ETFs change an asset's price dynamics. When a retail investor buys XRP on an exchange, there's a natural supply and demand equation. Buy pressure, sell pressure, price discovers somewhere in between. It's fluid, reactive, and relatively easy to move in either direction. But when institutional capital flows into a spot XRP ETF, something fundamentally different happens. That XRP is purchased from the open market and then it is locked. It goes into a vault. It is removed from circulation. It cannot be sold by the ETF provider, at least not without triggering massive redemption events that are tracked publicly. Right now, over $1.5 billion worth of XRP has been absorbed this way. Bitwise alone is managing over $330 million. Franklin Templeton, Canary Capital, Grayscale all building positions. And Goldman Sachs disclosed a $153 million exposure spread across multiple funds. These aren't traders. These are allocators. There's a massive difference. A trader looks for the exit before they've found the entrance. An allocator makes a structural decision and holds through volatility. They are not selling when the price dips. They are not selling when Twitter is bearish. They are not selling, period. This creates what you might call a structural floor, a price level beneath which the supply simply cannot go because too much of it is locked inside institutional vaults. And every week, millions of dollars of new capital flow into these products. Every week, that floor gets a little higher. Every week, the supply on open exchanges gets a little thinner. And when thin supply meets a demand catalyst, you don't get a gradual rise, you get a vertical move. Here's the part that I think is most misunderstood about XRP's value proposition, and it's the reason this cycle feels categorically different. For most of crypto's short history, tokens derive their value from speculation. You bought something because you hoped other people would buy it after you. It was belief all the way down. Musical chairs with better branding. XRP in 2026 is a different animal. The token has a mechanical reason to be in demand independent of what any retail trader thinks or does. Here's how it works. Every time a real-world asset moves across the XRP ledger, whether that's a tokenized treasury bond, a commodity contract, or a cross-border remittance, XRP is consumed as the settlement bridge. It is the grease in the machine. You don't get to move value across the ledger for free, and as the volume of value moving across the ledger increases, the demand for XRP to facilitate that volume increases with it. Last month, $900 million in tokenized assets settled on the ledger in a single day. The RUA market on the ledger grew 875% in 30 days. These aren't speculative projections. These are transaction receipts. Think of it like a toll road. When you build the toll road, you bet on traffic. The more traffic there is, the more tolls you collect. XRP is the toll. And right now the highway is being built. Institutions like Ondu Finance, Open Eden, and Gunningham are all driving their value across this road. And as more of them arrive, the toll becomes more valuable not because of narrative but because of necessity. There was a moment of genuine confusion in the XRP community when RLUSD's native stablecoin was announced. The concern was logical. If institutions can just use a stable, pegged dollar token, why would they ever need XRP? It's a fair question. And the answer reveals something beautiful about how this ecosystem is engineered. RLUSD is not a competitor to XRP. It's a funnel. Here's the mechanic: large financial institutions, banks, payment processors, asset managers are deeply uncomfortable with volatility. They cannot put a volatile asset on their balance sheet and use it as a transfer medium. The regulatory and accounting headaches alone would be catastrophic. So RLUSD solves the on-ramp problem. A bank enters the ecosystem using a stable, familiar dollar-pegged token. No volatility risk, no accounting nightmare, clean. But the moment they need to bridge that value across currency corridors from dollars to euros, to yen, or from one ledger to another, RLUSD alone cannot do it efficiently. XRP steps in as the liquidity bridge. It is the engine that converts, settles, and completes the transaction in seconds at a fraction of a cent, so every time RLUSD adoption grows, XRP utility grows alongside it. They are not in competition. They are in a symbiotic feedback loop. More stablecoins on the ledger means more bridging activity. More bridging activity means more XRP demand. More XRP demand means a tighter supply, and a tighter supply means only one thing for price. Now I want to talk about the chart because the technical picture and the fundamental picture are finally converging, and that convergence is rare. When you zoom out on XRP's price history, you see a pattern that has repeated itself. Long, agonizing periods of sideways consolidation, flat price action that makes even the most committed holders question their conviction. And then suddenly a near vertical eruption that recovers years of sideways movement in weeks. We are living inside one of those consolidation periods right now, and the specific structure of this consolidation is significant. The candlestick wicks are shrinking. The range between daily highs and lows is compressing. On a chart, this looks like the asset is running out of energy. But technically it represents something very different. It means the sellers are exhausted. The people who wanted to exit have exited. What remains is a holder base of committed, conviction-driven participants who are not reacting to noise. The 1.5 price level has become a psychological and technical ceiling. Every attempt to break through it has been met with sell pressure. But here's what most casual observers miss. Each failed attempt at resistance also absorbs sellers. Every time the price bumps into that wall, some of the sellers who had been waiting to exit at 1.5 complete their exit. And with each bump, there are fewer sellers left behind the wall. At some point, the price pushes into 1.5 and finds nothing. No sellers left, just open air. And that's when the real move begins. Open interest in XRP derivatives has climbed above $3 billion, a 23% expansion in recent weeks. The smart money is placing directional bets. They're not betting on what the price is, they're betting on where it's going, and they appear to be betting very clearly in one direction. Step back for a moment and think about what we're actually describing here. We're describing a network that has achieved legal clarity in the world's most important financial jurisdiction. We're describing an asset that the world's largest investment bank has disclosed a 9-figure position in. We're describing a ledger that is handling trillions of dollars in annual settlement volume and growing. We're describing an ETF structure that is systematically removing supply from the market every single day. We're describing a stablecoin ecosystem that creates automatic, ongoing demand for the underlying token. And the price is around $1.50. At what point does the math become undeniable? At what point does the gap between what this network does and what the market values it at become too large to ignore? History suggests that gap closes violently, not gradually, not predictably. It closes the moment enough participants simultaneously recognize the disconnect and then the price doesn't walk up. It teleports. That is the nature of suppressed assets with real utility. They don't trend up, they gap up. They leave latecomers standing at the station watching the train disappear. Before we go any further, I want to be direct with you. Nothing in this video is financial advice. I'm not your financial advisor, your accountant, or your risk manager. Crypto markets are volatile. People have lost everything. People have also made fortunes. The difference most of the time comes down to research, risk management, and not betting more than you can emotionally and financially survive losing. Do your own research. Size your positions responsibly, and never let YouTube videos including this one be the sole basis for a financial decision. Every major wealth transfer in financial history has shared one characteristic. The people who captured it didn't wait for consensus. They acted when the evidence was clear but before the crowd arrived. Because by the time consensus forms, the opportunity has already been repriced. The institutional flows are not a future event, they are happening now. The ETF absorption is not a projection, it is a present reality. The utility of the XRP Ledger is not a roadmap item. It is being used today, settling billions, growing every week. The debate isn't whether XRP has value anymore. The debate is now about how much and how quickly the market will close the gap between current pricing and fundamental reality. The casino is still loud. The slot machines are still flashing. The crowd is still distracted by the latest shiny thing. But in that quiet corner at that poker table, the biggest players in global finance are stacking their chips. The question is simply, where are you sitting? Drop your price target in the comments. $10? $20? Higher? I want to know how you're thinking about the post-clarity world and what you think is the single biggest catalyst the market hasn't priced in yet. Let's have that conversation below. And if you want to go deeper on the mechanics of institutional accumulation, ETF structure, and on-chain analysis, click the next video on screen. I'll see you there.